All right. Hello, everyone. Thank you for being here today on this Dairy Together webinar. I'm Bobby Wilson, and I coordinate the Dairy Together project on behalf of the Wisconsin Farmers Union. So I want to go over just a couple of quick things before we get started. First, you probably heard that this webinar is being recorded. So if you need to leave early or if you missed something, you will have a chance to watch it later. Everyone is on mute and your video is turned off, so you will not appear in the recording. This webinar is scheduled to go for 90 minutes, and we may close early if we run out of questions, but we do have a full 90 minutes for this presentation. The first half will be for Chuck Nicholson to give his presentation, and we'll use the second half for Q&A. So please feel free to drop your questions in the Q&A box at the bottom panel of your screen, just at any time during the presentation, and we will take all the questions at the end. If you are calling in by phone or having any trouble asking a question over Zoom, you can send me your question in an email. I will check there periodically and try to respond to questions during the webinar or follow up with you afterward. You can also send questions in the chat, but they will only go to me to read aloud. They won't be visible to everyone else. So please try and use the Q&A function as much as possible, but it's okay to drop things in the chat too. All right, today we're going to hear a presentation from Chuck Nicholson, agricultural economist at the University of Wisconsin, and he'll be talking with us about the research that he and Mark Stevenson have done on various dairy growth management programs. Their research has just been so helpful at informing ways to improve and stabilize milk prices and stem the loss of dairy farms across the United States, especially as we look to the 2023 Farm Bill as the window of opportunity to make some possible changes to federal dairy programs. So we know that for a long time, dairy farmers have experienced these boom and bust price cycles that are caused by an imbalance between supply and demand. And these price swings make it very difficult to manage a business. And over the last decade, the US has lost an average of 5 dairy farms every day. And in more recent years with the pandemic and the war in Ukraine and the supply chain issues that we've been seeing, it is just abundantly clear that consolidation comes with serious risks to our food security. So if we want to have a stable and resilient food system, we really need to diversify and redistribute food production and processing across the country. And there are already efforts underway at the USDA to start to do some of that. So part of that effort involves keeping farmers on the land and also making sure that new farmers can get started and have stable markets to sell into. So those are just some of the reasons that we've been advocating for growth management through our Dairy Together project. Back in 2019, we connected with Mark Stevenson and Chuck Nicholson and asked them to use their economic model and expertise in dairy markets to inform how we might structure a growth management plan for the US. And over the last couple of years, we've been working with a committee led by the UW Center for Integrated Agricultural Systems to refine some of the details of a growth management program. And that's how the Dairy Revitalization Plan that we'll be hearing about today was developed. So today, this presentation will be focused on the analysis of that program and how it would impact dairy farmers and the industry overall. There's probably a lot more that I could say about Dairy Together, about the different farmers and farm organizations who've been involved and how this proposal came to be. And I'm happy to chat more about that with anyone who wants to learn more, but I'll just keep it there for now so that we can get right into the presentation. I also just want to quickly note that Chuck Nicholson is an economist and not the author or the owner of this proposal. So please don't blame him if there are things about it that you don't like or that you'd want to change. He's done the economic analysis and really produced the data that can inform whether this is the kind of system that will benefit the US dairy industry. And from there, it's really up to all of us as dairy farmers, organizations who represent dairy farmers, and industry and congressional leaders to decide what we want to see and move it forward. So thank you all for being here. Thanks so much, Chuck, for presenting to us, and I will pass it over to you.
Okay, Bobby, thank you so much for that kind introduction and that qualification of what I'm supposed to be doing here. And thank you to those of you who are listening in. Happy to have a discussion. Look forward to getting your questions. I'm going to focus now on the presentation, sharing the screen here, so you see a lot less of me and a lot more of the things that we're going to talk about. But as Bobby mentioned, this is work that was done with my good friend and longtime collaborator, Mark Stevenson. We decided for the purposes of today that I'd be the one who would talk about it, but both of us, I think, would be happy to get future questions or respond to inquiries about what we've done. So my agenda for this actually is kind of got two major points. One is to remind us, for those who are familiar with growth management program type proposals, what we're really talking about, and introduce those who maybe haven't got as much familiarity. What are we really talking about? What kinds of things would a growth management program do? And then importantly, as Bobby said, to focus on the results of a study that would look back in a sense to say, if we had implemented this kind of a program 2 farm bills ago in 2014, how would the world be a different place than it turned out to be with that farm bill program that came in and brought things like the margin protection program for dairy. So we're going to look back a little bit to do that, but that gives us some insights about the likely impacts of a program like a GMP going forward. Okay, so let's jump right into thinking about what a growth management program is. This actually has quite a longer history, and as Bobby said in an introduction, I'm not really the author or the originator of this idea. The first time I heard about it was actually during the really terrible price year in 2009 out in California. And it brought about some initial discussions about how to structure some kind of program that would bring supply and demand better into alignment. And there's been a lot of discussion, and actually there's a lot of different ways in which we might implement a program like this, which actually kind of implies that there's some flexibility to do things in different ways. And I'll mention that a little bit more as we go forward. Okay. You may also recall, if you were thinking about these kinds of issues, that there was a considerable amount of discussion and even initial proposals to include a program like this in the 2014 Farm Bill. Ultimately, that was not something that happened. We ended up with much more of a focus on risk management programs rather than on programs to stabilize and enhance prices. But it actually got to the level of a conversation kind of heading into that 2014 Farm Bill. So we kind of have been to a place before where we've had some significant discussions about this. And I think we're at a mode now where we're kind of returning to that serious discussion about this as an idea. Okay. And along the lines of what Bobby said earlier, we're the folks who were asked to help analyze this based on our economic modeling skills and our dairy industry expertise. And I have to note that our work was supported, as Bobby mentioned, by the Center for Integrated Agricultural Systems here at the University of Wisconsin-Madison. Okay, so all growth management programs that we have looked at over a long number of years, actually going back more than 10 years now, have sort of 2 basic components. They have an allowable growth part that says how much you can grow, and they have a market access fee that says basically how much you would pay if you're going to grow beyond that allowable growth amount. And kind of very simply, we can think about this as providing carrots in the case of staying within the allowable growth. If you do that, you would actually receive money that's paid into a pool of dollars. And on the other side, there's kind of a stick that basically says if you exceed the allowable growth, then you would pay a fee in the years where you actually exceed that amount of allowable growth. So this is a program designed to provide carrots and sticks to help better coordinate the supply and the demand for milk in the United States. And the way in which we specify allowable growth and market access fees can be done in a lot of different ways, but the core is always there that we're trying to set these 2 things in place and better coordinate the supply and demand for milk. So one key thing, in case it's still not clear, is that this isn't a hard limit on growth. It's not a quota system like they have in Canada under the name of supply management. It actually allows for growth, but it tries to change the way the incentives work to maybe make that growth be a little bit different pattern and maybe a little bit more measured and slower as we go through the number of years. Okay. So on the allowable growth side, the program that we looked at for the analysis we did basically has a sort of like a tier system where if you stay within allowable growth, then you don't pay a market access fee. If you go a bit above the amount of allowed growth, you would be in a tier 1 category. And if you go more than an amount of tier 1, you would be in a tier 2 category. And so this is basically sort of saying there's 3 categories you can fall in. And the reason that's important is it's going to be based on the amount of allowable growth, either in terms of a percentage amount year over year on your farm, or the total amount of additional pounds that you produce compared to a previous year. That's related to the amount that you would pay for a market access fee. So if your production is larger, your production increase, excuse me, is larger than the amount of allowable growth, you would pay a market access fee. Importantly, you would only pay that in the years where your growth exceeds the allowable amount, not in all years. And again, this would be based on what category you're in, tier 1 or tier 2. So we also can think about programs that would say you're only going to pay on the additional milk, the increase in milk, or you're going to pay on the total amount of milk production, including the increase. And we've actually done some background work that suggests that a more effective program pays on the total milk production, not the additional milk production. So that's mostly what I'm going to focus on when I talk about our study results. Okay. So the key here is if you are staying within allowable growth and therefore are not in tier 1 or tier 2, you would actually receive a payment from the pool of dollars for the farms that are expanding in tier 1 or tier 2. So again, that's part of the carrot and the stick approach, that if you stay within that allowable growth, you receive a payment. If you are above that allowable growth, you would make a payment that would be then transferred to the other farms staying within allowable growth. Okay, so let me give you an example of one of the designs that we could think about. And again, this is just an example. I note at the bottom, there's a bunch of different ways we could structure a program like this, but this helps to maybe make it more concrete what we're talking about. Okay, so one way you could set this up is less than a 1% increase over the previous year. You are within allowable growth, no market access fee would be paid by you, and you would actually receive a payment from the pool of dollars for farms in tier 1 and tier 2. So that 1% would be the thing that we call the allowable growth in this case. And then tier 1 might be 1 to 4% increase over last year. And you would pay a tier 1 market access fee. And we might say, if you're more than 4% above where you were last year, then you would be in tier 2 and you'd pay a tier 2 market access fee. Okay, so that's sort of saying on a percentage year over year basis where you would fall in the allowable growth categories. And then that would determine the market access fee that you would pay. So if you're in tier 1, you would actually make a payment. And we looked at programs that actually had different market access fee based on farm size. Here are 4 farm size categories. They have larger market access fees as you get to the larger farm size categories. And tier 2, in this case, again, this is just one example, would have higher market access fees because you're in a higher growth category. Okay, again, here the market access fees are set on the basis of the farm size with these 4 farm size categories. Okay, so left-hand side, how much can you grow before you pay a market access fee, or what puts you into tier 1 or tier 2? Right-hand side, how much would you pay on all of your milk in a year where you were expanding 1 to 4% for tier 1 or more than 4% for tier 2? Okay. So that was kind of the simple example, if you will, even if it seemed complicated enough. We actually were asked to look at a number of different design options. So this is one of those my eyes glaze over type tables where you're looking at lots of different stuff. If you wanted to go back and look at this later on to look at the different things that we did, that's fine. But the real focal point for this is going to be a comparison between the thing that's now called the Dairy Revitalization Plan. It was our number 3 option, and a program where we didn't have GMP. We just had the usual dairy policy instruments that were implemented in the 2014 Farm Bill. So this table mostly tries to say there are a number of different ways that we could structure this program. We looked at a number of the outcomes from those different ways. This was the design option that seemed to have the most resonance with the audiences that we were interacting with. And that's why it'll be the focal point for what I'm going to talk about in terms of results. Okay. So one of the questions that always comes up when we think about growth management, now that we've talked a little bit about the basic designs of the programs, is this kind of a program that's going to allow new farms to enter, especially given that new farms often are ramping up production over a number of years? And we decided to evaluate this by looking at kind of a what if new farms entered and we allowed them to come in without paying market access fees, would that be sort of a bad thing for the implementation of a growth management plan? So can we think about allowing new farms to enter under this kind of a program and still have the program be effective? So it's a little bit hard to guess how many farms might enter in a given year. We've had net rates of decrease in farm numbers throughout the US, but especially here in Wisconsin. But we basically looked at this as saying, if we had 60 new farms that came in every year for a period of 8 years, so close to 500 total new farms entering during this 8-year period that we're analyzing, what would happen? Would that be a problem for the implementation of the program? We allowed a grace period of 3 years for those farms to ramp up to kind of their full production capacity. And what we found was basically that there would be no major bad impacts on a GMP. You could actually allow new farms to enter, give them a 3-year grace period, and still have an effective national program. Okay, so I think that's kind of an important point, that this is a program that can accommodate the entry of new farms, even with a grace period where they're not going to pay market access fees as they expand their production. Okay, so there are a lot of different things that people would be interested in looking at when we think about the impacts of a program like this. I've listed some of the key ones there in the screen that you see on the left-hand side. Obviously, milk prices, but also how variable or unpredictable are those prices. Farm profitability that we measure with this idea of a net farm operating income. But things like exports and dairy product trade get a lot of attention. Things like government expenditures on the current dairy programs that we have. Are there possibilities to save money? Kind of becomes one of the key questions. And then also, what's this going to do to our domestic marketplace in addition to how we act in export markets? So we looked at all of these different outcomes, and I'm going to share those key results with you as a part of our conversation. You might say, how do we do this? And it's a little bit of a complicated story, but we actually have an economic model that includes all of the world's key dairy countries, importers and exporters. And for each of those, it represents sort of different parts of the dairy value chain, farms, processing, the demand side, as well as the trade between countries. And we developed this tool over kind of a long number of years. It has been vetted by a number of different other academic professionals and international organizations. And so this is the tool that we use to assess the kinds of outcomes that might take place under a GMP. And again, the key thing that we're doing here is we have a little bit more knowledge about where we've been. So we're looking back to say, what if we'd done something differently 8 years ago with the 2014 Farm Bill? And we're going to look forward to see how a GMP would compare to kind of what actually happened. And so that gives us a way of comparing the impacts. And that's actually really kind of the only way we can think about this kind of a program, is to compare it to something else, like what would have happened if we did this versus something else. Okay. In case it's helpful to have a little bit more background on the farm part of our modeling work, we have basically 5 different categories of farms. They're based on the amount of milk production, but also on the production system. So for example, we have a Wisconsin grazing farm, which has a little bit different cost structures and responsiveness to kind of market incentives. And that was a key contribution of the Center for Integrated Ag Systems. And we actually have this for sort of like 2 different regions of the United States. For historical reasons, we first focused on California. So we have kind of California farms and their responsiveness separated out from farms in the rest of the United States. So the key thing that we found, now that I've talked a little bit about the way in which we did the analysis, so we found that all of the different designs, but especially the one that I'm going to focus on, would have certain kinds of impacts. That is, they could be effective at achieving certain kinds of outcomes. So they would reduce price variation, the unpredictability of prices, the variability, and they would enhance average farm milk prices. Okay. They would increase the profitability of farms, again, as measured by this idea of net farm operating income. And that was particularly true for farms that stayed within the amount of allowable growth across different farm size categories. Those two things that I just mentioned would generally be things that we'd say, that sounds good, where we might have a little bit more pushback from other people in the dairy value chain, or when we talk about some of the impacts on prices further down that value chain. And we actually would expect that there would be some increases in wholesale dairy product prices and also in retail dairy product prices. That also has some implications for how much of those products either export markets or domestic markets would buy. So we saw that we would reduce the rate of growth in dairy exports, but that dairy exports would continue to grow during this time period. And we would decrease also the rate of growth in domestic consumption, but there would be continued growth in dairy product consumption in the United States. Okay, so that's kind of the high level view of the things that we found from our modeling work. Let me give a little bit more details about each one of these different outcomes. Okay, so this is a chart comparing the average all milk price basically during an 8-year period that we analyzed, comparing the baseline run, that is the current farm bill policies that we put in place in 2014 and then modified in 2018, with a growth management program along the lines of what I described to you, that would base its allowable growth on volumes and would have market access fees that varied by farm size. So on average, we predicted that average all milk price would be increased by about $1.40 per hundredweight. And so that is kind of the average difference that we're looking at. But we can also look at this as a graph over time. And these are coming from our model results. You see some ups and downs there that are largely due to seasonal variation that we expect in milk prices. The black line is under the current programs that were implemented in the 2014 and 2018 farm bills. The blue line is what we would expect under a growth management program. And you can see that there is almost always a higher all milk price under the GMP. There are a few places where we get into 20 and 21 where they get kind of close. But on average, that's where that $1.41 difference is coming from. But you can see at different periods of time that average is different. But one of the other things that the GMP is doing, and the reason that we end up with those higher average prices, is basically it's taking away a lot of the cyclical variation in milk prices that we see. And I'm kind of representing that by showing this red line here that basically says we tend to see cycles in milk prices, farm milk prices. They have an average kind of peak to peak of about 3 years. But what a growth management program would do would be take away some of the incentives for making milk when prices are high and cutting back on milk when prices are low, and sort of smoothing out what those price cycles look like. So on average, the prices are higher. They are also more stable, and they're less cyclical, less variation that's kind of this big up and down over a period of years. Okay. So this is related to the fact that we have lower variation in milk prices over time. That's kind of the thing that I just showed you in the previous graph. We have a number of different ways in which we can measure this. But basically what we're looking at is there's about a 21-cent reduction in the average variation in the milk price over that period of time. So we're making prices less variable, also kind of a little bit more predictable in that sense. Okay. So one of the other important impacts to talk about, again, is farm profitability. And I've got a graph here that's actually showing you this baseline profitability that we would project the average annual net farm operating income during the period of time that we analyzed. And the yellow bar is the one without the growth management program. That is, it's got the farm programs that were implemented. And then a little bit more complicated story is off on the right-hand side where there are 3 bars. And those 3 bars are representing farms that were within the allowable growth, kind of their average during this period of time. Farms that expanded but were in tier 1, and farms that expanded that were in tier 2. And the basic takeaway from this is that the profitability increases are largest for the farms that stayed within the allowable growth. That's the carrot part that we're trying to get them to respond to. But even farms within tier 1 were more profitable in part because of the average higher all milk price during the period of time we're looking at. So even if they paid the market access fee, they benefited in terms of their profitability status from the higher all milk price in the marketplace. And tier 2, interestingly, was also just a little bit higher than the no growth management program. Those would be farms that are paying a higher market access fee, but they also still benefit from the higher average all milk price in the marketplace. Okay, so basically there's an improvement for all the farm size categories in their profitability under a program like this. It just depends, how much depends on which of the tiers that you're in, okay? So importantly, in addition to the increase in the milk price, that also drives increases in farm profitability, okay? One little quick aside, we actually developed a tool, again with support from the Center for Integrated Agricultural Systems at UW-Madison, a tool that would allow individual farms to assess the impacts of a growth management program on their farm by entering information that you see on the left-hand side there about an initial amount of production and then increases over the subsequent 4 years. And there's a series of graphs that will show the amount of payments, that will show and track the intended amount of milk production over time. And then essentially, one of the core things this provides is when would I break even on paying market access fees versus receiving higher milk prices from the marketplace, as well as ultimately receiving payments myself when I'm not above allowable growth. So the URL, the website address for this tool is shown there. Happy to put that in the chat later on if that's something that would be of interest. But we found it really important that farms be able to evaluate for themselves some of the likely impacts of this kind of a program. So that's why the tool was developed. Okay. So that kind of summarizes the farm price and profitability impacts. Now we want to think a little bit about the downstream in the dairy value chain. So when we have higher farm milk prices, typically that translates into some effect on the dairy product prices, either at the retail level or the wholesale level. And so in this case, we're looking at the impact on a gallon of milk at the retail level. Again, average during this time period, it varies a little bit during that time period, but an average increase of about 15 cents per gallon, okay? So, and that's on a base here that looks like about $3 a gallon. You can think about what that is on a percentage basis. To me, this is kind of at the edge of where consumers would probably begin to notice that the price was higher, but it's not a very large percentage increase that would, cause considerable amount of attention to be paid to this issue, okay? So we can also look at some of the key price impacts on wholesale markets. One of the key things that's obviously really important for the growth of the U.S. Dairy industry is what's been going on in cheese demand. This suggests that there would be about an 11-cent increase on average in the wholesale price for cheese under this kind of a program. Again, that is probably at a place where some people might begin to notice it, but it's not something that would be considered probably like a major deal breaker on the part of a lot of the consumers in terms of the kinds of products they might buy. Okay. So we can think about categories other than cheese. And one of the things I'm trying to point out here is we might expect some differences in the impacts of a program like this on domestic sales. And this is actually looking at, if we take all the sales during that 8-year period of time we analyzed with and without a growth management program, what's the percentage difference? And part of the reason to do that is to understand how different product categories might be affected differently. Here we're showing the biggest increase or biggest impact on American cheese, less of an impact on fluid milk products, and then intermediate product impacts for the other products that are shown there, other cheese categories, butter and non-fat dry milk. Okay, so this suggests is there going to be a negative impact on sales, but I think it's also important to kind of put this in the perspective of does growth continue to happen in the US domestic market? And this is kind of a complicated graph, but it's actually showing for both cheddar cheese categories that we analyzed and other cheese that's primarily like a mozzarella or pizza cheese, the patterns of growth over time with and without a growth management. So for example, on the bottom 2 lines there, we're looking at cheddar cheese. You see with the growth management program in place, we don't grow as quickly during certain periods of time as the red line, which is the baseline or no GMP. But kind of interestingly, we start out in 2013 and end up at the end of 2021 in about the same place. And there's actually kind of a similar pattern when we look at the other cheese categories. We grow kind of more steadily and slowly with the growth management program, but the other cheese category has greater ups and downs along the way. We start and end at about the same place. But the differences in the overall amounts that I showed you in the previous slide are being driven by factors like this. There are certain periods of time where we expect higher sales without a growth management program. There are other periods of time where those sales end up being roughly or approximately equal. Okay. And another key thing that always comes up when we talk about making changes to dairy policy is what's this going to do to our presence in export markets? Many of you probably know that we have greatly expanded our export sales, and we now are exporting in terms of our dairy components, fat and non-fat solids, almost 1/5 of the components that are produced in the United States. So it has become an important consideration to think about how would this affect our presence in export markets. And the story in export markets is a little bit like the one I just showed you for domestic markets. We would see a reduction on average in the value of dairy product exports. And that actually is that 369 is the average difference of about $369 million per year reduction in dairy exports. Okay. But again, that's in the context of thinking about whether or not we still have growth in export markets. And this graph is showing you with the GMP, we would actually have, again, slower but continued growth in export sales. Also a bit more stable presence in export markets in terms of the total value of exports that we would make. Okay. So for both domestic markets and for export markets, we can continue to grow the markets under a growth management plan, but the growth would be a little bit slower, but maybe also a little bit steadier. Okay. So, and finally, one other thing that comes up in discussions, particularly when folks turn their eyes to Washington, is what's this going to do to the costs that the government would incur? We analyze this by looking at the differences with and without a GMP on the expenditures that would be made under the Dairy Margin Coverage Program. And basically what we found is that we could have a total expenditure savings of about $2.6 billion on DMC payments with a growth management program in place, in part because higher milk prices would result in fewer times when an indemnity payment under that DMC program would be made. So the government would have to pay smaller amounts of money to dairy farmers under DMC with this kind of a program. Okay. So that highlights the different kinds of outcomes that I wanted to talk about. Let me just wrap up now by saying these program designs seem to have the capability of doing some things that many people think would be desirable, like reducing price variability, increasing farm milk prices and farm incomes, reducing government expenditures on a program like DMC. They have some other things that maybe are a little bit more controversial, like slowing the rate of growth of U.S. dairy exports and increasing domestic dairy product prices and reducing the rate of growth in domestic consumption. So there are some things here that I think would be considered quite positive outcomes for many folks. There are some things here that other folks might have concerns about. And so it's really up to the industry as a whole to think about the kinds of trade-offs and the kinds of positives and negatives of a program like this. And that's what we're trying to help provide some information about with our work. Okay, so that's my prepared remarks. I'm going to go ahead and stop sharing here, and then we can see if there's additional questions or discussion that we should talk about. So thanks, Bobby.
All right, thank you. So folks can go ahead and drop questions in the Q&A box, and we will just take as many as we can. I also have some questions that have come in before the presentation, so I can kick us off with a couple of questions. But first, just one kind of a going back to the basics question. Can you just give a little context about why we see volatility in dairy markets and sometimes these very long periods of low prices? Why do we see that, and why does growth management work to correct that?
Okay, so one of the things that I do here at the University of Wisconsin is teach students about supply chains and supply chain coordination. And so essentially, when we see big price swings that are like the price cycles we've seen, that is an indication of a lack of coordination between the supply part of the supply chain and the demand part of the supply chain. And this is not unique to milk or dairy products. Actually, many agricultural commodities have price cycles. You may have heard of beef or pork price cycles as well. But it comes from the fact that the folks who are on the production side are not closely tied to the decisions that are made on the demand side. And so that lack of coordination means that we can sort of over-respond to incentives when prices are high, and then have to sort of retrench when prices are low or margins are low. And so the reason a growth management program can address this is it sort of slows down those incentives to get bigger when prices and margins are higher, because it requires you to put some money into the pool to be able to do that. And it also smooths out the bottoms by paying folks when they are not expanding, okay? So it doesn't directly affect the coordination issue of making milk producers talk to milk buyers, but it provides some incentives in that supply sector, that production sector, the dairy farms, to help them think more carefully about aligning their production decisions with the needs in the marketplace. So I hope that helps.
Yeah, that does help. And you mentioned that other agricultural commodities experience some of these price cycles. What about looking at other industries outside of agriculture? Do we see any sort of growth management or supply chain coordination as an example from a different industry?
Yeah. So one of the ways we can think about how agriculture supply chains are different than others is to think about how, until very recently, it worked in dairy. And for the most part, production decisions were made by individual farms. If you wanted to expand and your banker said that was okay and your co-op was going to take the milk, then you could certainly do that. And that gave you every incentive to and ability to respond to especially increases in profitability, but also for reasons of I need to grow my farm to bring somebody back for the next generation, okay? So that was an independent decision that we made by the farm. But that's basically not how it works in just about any other part of the economy. So it would be like saying General Motors saying to a supplier of engines, send me as many engines as you want, and I will figure out what to do with them, right? That's not how it works. They have a very closely coordinated supply and demand system where they say, I'm going to need 1,000 engines to go into the production process on this day, and they work back very carefully from that to make sure that that is what is going to be supplied. So there's a very tight coordination in a lot of parts of the economy between that supply and demand part of the supply chain that we just don't have in agriculture. And that's why we tend to see these unstable prices. That's why we tend to see big swings in prices, especially over longer periods of time.
Okay, thanks for that. And it's,
Yeah.
I imagine it's probably easier to stop engine production than it is to stop, to turn off a cow and stop milk production. So maybe with dairy, we've got extra levels of complication here, but.
Yep, actually with a biological process and one that depends on where the cow's been in the past, yes, absolutely.
Yeah. Great. Well, we do have one question that's come in here. Are DMC payments included in the baseline, or would they need to be added in order for a farm to compare what their income over cost would have been?
So in the analysis that we did, DMC is included for both of the programs. So the net farm operating income actually includes any margin, any payments that were made, and the indemnity payments, as well as any premiums that were paid under that program. And we had actually looked at, it's a little bit hard to predict in any given year what farms might have done, but we looked historically at what farms in different size categories had done in terms of their coverages, in terms of the amount of milk covered, as well as the margin levels protected. So that's all in there, and it's consistent across both of the different compared scenarios that we looked at. Hope that answers that question.
All right. Well, going back to one of the earlier slides that you shared with the tiers of allowable growth and market access fees, somebody wanted to just have a little bit of clarification or put a finer point on how those tiers maybe stack on top of each other. Can you give an example of how, maybe just an example of a farm that might exist in tier 1 or tier 2 and what they would end up paying in market access fees? Well, maybe
Okay.
maybe the rate, not the total amount that they would pay, but just which they would pay.
Yeah, actually, so the online tool that I mentioned will actually give you both the rate that you would pay per hundredweight on all your milk, as well as the total amounts. And it also factors in, when you're not in tier 1 or tier 2, the amount of payments that you would receive back. Okay. But the example that I showed in the very brief online tool slide that I showed was a farm that was starting out at about 4 million pounds. And they were increasing, like in the first year after that, by 1 million pounds. Okay. And actually, let me if I can make everybody's eyes a little bit funny by shifting back to the slide presentation. Maybe I can use an example here to show you. Okay. So I don't know if folks can see this, but this is maybe kind of a very specific example. Again, for that farm starting out at 4 million pounds, 40,000 hundredweights per year. The bottom part of this table, and I know there's a lot of numbers there, is looking at staying at 40,000 hundredweights per year. What I'm going to talk about in the top part here, sort of step by step, year by year, is an increase of 1 million pounds in the first year. Okay. Bobby, is that kind of the thing you think would be helpful here?
I think this would be helpful. Yeah.
Okay. So we'll come back to looking at the bottom part of the table here in a second. But as I said, if you start out at 4 million pounds a year, and in the first year after that initial year, like kind of your base production amount, you increase by 1 million pounds, then you're up to 5 million pounds and you have 50,000 hundredweights. Okay. The second of the, well, I guess it's the third of the columns there, says basically you're increasing by 1 million pounds or 10,000 hundredweights. That's a 25% increase over your previous year. So under a program that had say a 4% allowable increase before you were in tier 2, that would put you in tier 2. You would pay a market access fee on all your milk for that year of $1.50 per hundredweight. And that's based on a farm size of that, a farm in that size category having a market access fee in tier 2 of $1.50. The total amount of payment would be $75,000. for that additional 1,000,000 pounds of milk. You wouldn't receive any money from a market access fee program. So the average milk revenue that you would get basically is going to be the market price in that year, which we would predict for this example at 17.70, less the amount that you paid for the market access fee of $1.50. So that gives you 16.20. Okay. So the following year, basically, if you stay at that 5,000,000 pounds, your increase in milk production would be zero. Your percentage increase would be zero. You are within the allowable growth. You don't make a market access fee payment in that year. And in fact, we would estimate you might receive a payment of about 60 cents per hundredweight from the growth management program. That's about $30,000 total per year on the 5,000,000 pounds of milk. And it gives you a milk revenue of 17.70 from the marketplace plus 60 cents from the pool of dollars from expanding farms. And that gets you up to about 18.30. Okay. And for the third year, we would actually see the same kind of results. If you stayed at the 5,000,000 pounds, you would receive maybe an expected payment of about 60 cents per hundredweight. Your average milk revenues from the marketplace plus the program would be about 18.30. Okay. So looking at the period of time from when you started the expansion through those next 3 years, you have an average milk revenue of about 17.60. If you stayed within the allowable growth for those 3 years, you would have an average milk revenue of about 18.30. And that's because you never paid the market access fee of $1.50 in that first year. So I don't know if that helps provide a kind of more concrete example of how this might work. But again, I would suggest for anybody really interested in understanding the details for their farm, that online tool would be a really good place to go to try out some different things and see what you would pay under different programs. And again, importantly, when you might reach a break-even point. Okay. So I'll stop the sharing on that now and see if that helps.
Yeah, I think that example does help to see just a more concrete numbers. And so in that particular case, you can really see the carrot that it's saying that you can be just a little bit better off if you just stay at your current level of production, whereas before there might have been a carrot or an incentive to make that expansion decision in order to increase your milk revenues.
Yeah. So again, it's a carrot and stick. It's not a hard wall. So it allows for that expansion to happen. It's just trying to maybe make it a little bit more of a thoughtful decision. And in particular, one of the things that comes up is to be careful about incremental growth. So when you're going to grow in a more thoughtful way than it kind of just sneaking up on you.
Mm-hmm, mm-hmm.
Yeah.
Rather than just adding 10% every year as kind of your growth strategy, maybe just making an expansion decision and then letting your business recover those costs from the higher milk prices that follow.
Yeah. And I guess the other thing is we tend to see genetic improvements in the dairy herd every year. That tends to be about 2% on average. So that's another factor, is that 2% in your herd just from improved productivity could actually put you into a tier 1 situation if the limit is 1%. So it's kind of something that trying to get folks to be thoughtful about through the design of the program.
Yeah, that's an important point. So folks can continue to put in questions into the Q&A, and I'll keep running through some of the ones that were submitted in advance. One question that came from some dairy farmer out in California was just hearing some concerns about the market access fees being higher for larger farms. That might be kind of a tough sell for larger dairies in California and out west. So I know you kind of went over this in your presentation already, but
Yeah.
can you reiterate why the market access fees are set at those levels and how maybe having a across the board market access fee would impact the program? Yeah.
Okay, yeah, thanks. That's a really good question. So I think the basic idea behind this is to look at where we have seen the biggest growth in milk production in the United States in recent years. And essentially, almost all of that growth is coming from the farms that are in the larger two of our farm size categories. Okay. And relatively limited growth, or sometimes even declines in total milk production, are coming from the two of the smaller farm size categories that are part of our analysis. And the economic logic is, if that's where the growth is happening, then you want to have sort of a bigger set of carrots and sticks applied to that big part of the growth than you do for parts where there is less of the growth happening. And so it's not really designed to be a sort of a punishment for being big. It's only trying to recognize that that is where the growth is happening. And that's where we need to sort of provide the bigger carrots and the bigger sticks in order to help sort of rein in that growth and make it more managed. Okay. So we have looked at programs where we charge everybody the same market access fee. And the bottom line on that is that we could have a program that would be effective at doing the things that I talked about, having the kinds of outcomes that I've talked about. We'd have to actually set a bit higher average market access fee if we apply it to everybody than we do if we make the differences by farm size. If there were great concerns about the fact that there were differences among farm size categories, a program could be designed to be about equally as effective that doesn't have that as one of its features. It can charge everybody the same market access fee.
Okay. And well, you mentioned earlier that some of those farms that would be paying the higher market access fee would still be in a pretty similar situation, even with paying those higher market access fees, because they also have the bigger carrot, as you said, that they also get to reap the benefit of higher prices. And if they choose not to expand the following year, then they get to also draw from that pool of market access fee dollars. So there are still some benefits, even if the program is structured in a way that has the tiered system.
Yes, that can be. Yeah. And actually, we have more detailed analysis by the different farm sizes than I showed you in some of the reports that we have available online.
Okay.
So happy to have folks tap into that if that's helpful.
Great. All right, and feel free to keep questions coming in. Similar or kind of along the same lines of maybe having or a situation that we might see more out west is when an owner has multiple farms. So it's one owner, but they own multiple farm sites. Would you assume that each of those farms would be considered a separate business entity and they would all have their own production base? Or how do you suppose that those farms would be treated under this program?
Yeah. Well, it's actually kind of a program design issue. And we did not look specifically at that because we don't get down to the level of individual farms. My response on that would be that a program could be designed in a lot of different ways. I think you could do it as one combined business entity. You could do it as multiple business entities having that production base to start out with. I think the more important thing is when we think about the entry of new farms and the possibility of a grace period, we have to have in place a set of rules and regulations that does what the program intends, that those are really new farms. Mm-hmm. And so there has to be some definition that would say you haven't previously been in dairy production, at least for so many years. I don't think the effectiveness of the program would be affected by saying you have two business entities versus one combined business entity, because we've sort of looked at this with our modeling tools as an aggregated kind of process. So I don't think that that would necessarily affect very much the kinds of outcomes from the analysis we've done.
Okay.
Hope that helps.
Yeah, we've heard some concerns about the grace period for beginning farmers being a potential loophole that could be manipulated, and so that makes sense that in the legislative language it would have to be clear on who's truly a beginning farmer, and make sure that that's not something that is exploited. So
yeah,
great. Well, a couple other questions here. One is how can the program be designed in a way that the base doesn't acquire value? Maybe this is another thing that is more related to the way that the legislation is written and how the program is rolled out than the economic analysis of it. But just wondering if you have any insight on how to do that, or maybe how this was done in the original design of the Holstein plan.
Yeah, sure. So let's think for a minute about what happens in Canada, where you have to have a quota and the quota is tradable. And one of the things that's happened there over a period of time is that quota has taken on a lot of value and basically been pretty expensive, and in and of itself kind of constitutes a barrier to growth. The key thing that would need to be different about a program like this is that the base is not transferable. At least from one farm business to another farm business. You can think about if the business is being transferred to a next generation, that would certainly, it could be covered, but it's being transferred to a completely different entity, then basically the production base is not something that you can sell. So that transferability of the production base is really what allows something to take on value. And so that would kind of need to be a core design feature of this kind of a program. That's how we've looked at it. And I think that's what the intention was, that you couldn't transfer your base and that would prevent the base from taking on value.
Okay, so the base stays with the facility, not with the cows. So if you sell the cows, then the base doesn't go with them. That's
Doesn't
it.
go with the cows, right?
Okay.
Right.
All right.
Yeah.
Great. All right, kind of on a different track here. Looking at organic dairy farmers, I know we have a lot of organic producers in Wisconsin and Northeast and really across the country. How do organic farmers participate in this program, and how might it impact the prices that they are paid?
Yeah, so again, as a program design idea, you could either say organic producers are in the program just as anybody else is, or you could say, well, they have some different kind of production and marketing characteristics, so they will not be involved in paying the market access fees. That's actually kind of a program design issue, again, if you're thinking about the legislative language or the implementation. So that could go either way. We did not analyze kind of including or not including organic. We assumed that organic producers would be a part of a growth management program. My guess would be that you could implement a program that would not require them to pay market access fees, and that would be okay, especially given some of the other market developments and constraints on their supply and supply chain that have occurred in recent years. Yes, one other thing that's kind of a point of contact, whether organic producers are involved or not, is that people in the grocery store make decisions about organic versus conventional milk based in part on the prices that they see. And so if we have that 15-cent increase per gallon in the retail price of milk, for conventional milk, which is what we were looking at, that actually maybe lowers the price spread with organic. And so organic producers might find that beneficial because they're not looking at as big a difference between organic and conventional milk, which would tend to have people switching more towards the conventional side. So there may be some indirect benefits in the marketplace, in the retail store, from that price gap being a bit narrowed.
That makes sense. Great. Well, one question has come in. I'm not sure if this is one that you'll be able to speak to, but someone asked if the Dairy Revitalization Plan really provides enough incentives for dairy farmers to want to scrap the existing system and support this revised system.
Yeah, I guess since I'm not a dairy farmer, I can't speak from a practical experience about that. And I've given presentations about this plan for a number of months. And sometimes I say a number like $1.41 increase per hundredweight, and people go, wow, that sounds great. And other people say, that's way too small. And so I think there's a great diversity of opinion out in the industry about whether this kind of a program with these kinds of impacts would be sufficient. I guess the other thing that I would say, though, is that that 141 per hundredweight is based on one program design, and it's quite possible to have a different program design that would result in a bigger amount per hundredweight or a lower amount per hundredweight. So I think it's kind of an important conversation for the industry to have, to say, how much is enough change for me to buy in to change the current system, and how much means that I might think I'm better off just staying where I am. And so that's kind of the key question. And a lot of folks will have different answers to that question, I think.
Sure. Yeah, and in our conversations with dairy farmers over the years, we've also heard that kind of range of perspectives, that some people say it goes too far and some people say that it doesn't go far enough. But I think everyone tends to agree that the system that we have now is pretty difficult to get buy-in, and that having some sort of a change that will positively impact prices overall would be worthwhile for most of the folks that we've talked to. So maybe that's kind of a question for the group or the folks that are on the call. Is this does this program seem worthwhile to approach and to start to make some changes to the way that we structure things now? Okay, great. Let's see. One question that we had in advance was about any regional differences in demand for milk. This person was saying that in the Southeast, for example, they tend to have a milk deficit. So would this program make it more difficult to fill those plants, or how might we be able to account for regional variation in demand for milk?
Yeah, so it's actually possible to think about designing a program that would kind of provide more carrots and fewer sticks for expansion in areas like the Southeast that have seen significant declines in milk production. Again, we haven't gone to that level of complexity in analyzing the program. But it certainly is the case that we have some long-term trends in certain parts of the country, like the Southeast, that have some significant impacts on the availability and the cost of dairy products. But they also create opportunities in other parts, other locations of the U.S. dairy supply chain for folks to make milk and have it be sent to, say, Florida as packaged milk. Okay, so again, we didn't look at the possibility of having regionally defined allowable growths or market access fees, but within the design of the program that we have, that would be a possibility. Okay, so if we want to incentivize additional milk production in areas that have been declining or struggling to keep the milk production up, that would be one way to do it, using adapting this kind of a program.
Okay. And is it maybe safe to assume that in some of those areas where it's declining, like in the Southeast US, that maybe they have smaller dairies that are, potentially going to be in a better position to stay in business or to grow a little bit if we have higher prices and this type of system in place?
Yeah, so in general, what we find when we look at, I didn't share results about this because they're maybe a little bit harder to get a handle on, but in general, what we would see in terms of the size and numbers of farms from a program like this, we would actually slow the rate of growth and the number of farms that are kind of in the largest farm size categories, and we would reduce the exits that are taking place in the smaller farm size categories. So to the extent that we're interested in trying to have a larger number of smaller farms, and kind of slow the rate of progression of the number of farms in the biggest farm size categories, this program also seems to have those kinds of impacts, particularly if we adopt that strategy of having the market access fees be higher for the farm sizes where we're seeing most of the production growth. Mm-hmm. Okay. So it has the potential to basically keep more dairy farms around, especially ones that are kind of in those smaller farm size categories.
Okay, that helps. Thanks. Thinking also about processors. So we can assume that this could be a potential downside to processors, is that they are going to have to pay more for milk. They're the buyers of this milk. So for increasing prices to farmers, and they're the ones that are paying those extra prices. What kind of impacts might we see in the processing sector? And are there maybe some potential benefits or trade-offs that maybe you have to pay a little bit more
Yeah.
for milk, but there's something else in this program that benefits you?
Yeah. So, yeah, I think you're absolutely right, Bobby, that what we're looking at is if there's an increase in the all milk price, we're also looking at generally increases in all of the classified prices that are being paid by the first buyers of milk, the dairy processors. And for many of those folks, this is a significant concern because it is a major input cost, often by far the largest of the input costs that they have. Okay. So there's some understandable concern there, but I think we need to maybe think about a couple of things that might sort of take away some of the things that would be considered negative aspects of that. One is farmers don't like price variability, but also processors don't like price variability. So to the extent that a program like this makes prices more predictable and less variable, that provides some benefits in terms of helping processors with the management complexity that they deal with day in and day out. The other part of this is that it kind of relies on the link between the processors and their customers, but it depends a little bit on how responsive those buyers are, the ultimate buyers of dairy products are to any kind of price increase. Okay? So under certain situations, it can be the case that you will sell less, but you're selling at a higher price. So there can be a bit of an offset to the higher milk price that you pay for your ingredients, your inputs. Sometimes that can be compensated by a little bit higher revenue because even if you sell a little bit less, selling at a higher price may result in a total amount of revenue that is bigger. And there's some, economic things that we talk about when that happens. Not going to happen all the time. The effect might not be big, but at least it provides some kind of window on a potential offset to the processing sector of what's going on with the higher input costs for milk. Okay, so both the stability and what happens to the revenue side are things that would need to be explored further with folks in the processing community to get their perspective on that.
Sure. Yeah. I mean, we hear a lot from dairy farmers about how they're impacted by that unpredictability and just really not knowing from month to month or year to year what the price might do. But I think the processors also feel that on their end too, that it's probably hard for them to predict how much they're going to pay for milk from month to month and year to year as well. So having that stability, I could see benefiting both sides.
Yeah.
Great. Well, a couple other questions have come in here. So one person is asking, are you indicating that the farmer's milk price would be around $17 to $18 per hundredweight? If so, that does not consider our input costs, which are changing daily. The farmer needs their cost of production included in interpreting the price. Do you have a response to that?
Yeah, so absolutely important to think about the relationship between the milk price and the cost of production. I mentioned that we're measuring farm profitability looking at basically the price you get paid for milk and under a GMP, any payment that you would get or payment you would make, minus the operating costs. And we're looking at average operating costs across the different farm size categories based on the data that we have available to us. And that means that we are probably not, absolutely are not representing, all the different possible combinations of a milk price and an input costs. Our current pricing system in the US doesn't directly account for the cost of production. It actually is based on the values of prices of the products in the marketplace. So this program doesn't directly address that issue of the fact that the milk price is not based on some notion of the cost of production. Okay, so in a supply management program like they have in Canada, that's actually explicitly taken into consideration. This program doesn't have that feature. It doesn't actually say, okay, well, we need to make sure the milk price covers the cost of production for 80 or 90 or 100% of dairy farms.
Mm-hmm. Yeah. And with this question too, the first part of it asking about if the farmer's milk price would be around 17 to 18 per hundredweight,
Yeah,
that was an average. That's not to say that it's always going to be around 17 to 18, right? You're still going to see, right now it's in the $20 range. So
right.
it's not to say that it would be 17 to 18 just, continuously.
Yeah, that's right. So it's an important point is that is the average over an 8-year period of time. And in fact, as we get towards the end of that time period, you may remember some of the graphs were heading up and getting over that $20 range. So it's the average. That's just to kind of have one simple number that we can refer to compare kind of with and without GMP.
And is that relatively close to the average cost of production nationally, somewhere between 17 to 18? I know we do have a pretty wide range because we have a wide range of herd size categories and different types of operations, but is that close to average for the US?
To be honest, I don't know what the current cost of production is. I do have actually ongoing research where we're looking at that in the state of Wisconsin. But the one thing that I do know is that when we look at the data in any given year, we can have a range of $10 or more in the cost of production across the different farms that we have data for. So even if you have an average value and it's close to $17, that is a really difficult thing to interpret for any given farm because their number could be very much higher than that or very much lower than that. So the basic idea is that in this case, averages probably don't help us very much. So knowing what your cost of production is, and the other thing is that we have some different ways in which we measure cost of production. USDA's Economic Research Service tends to report values that include their estimates of what we call the opportunity cost. So the value of all the assets and the value of the labor that's provided by the farm. Not all accounting systems that report cost of production include those things. And that's one of the reasons that we see this really big range.
Okay. That makes sense. Yeah, and it seems like maybe you could structure a program in a way that does tie the milk price to cost of production, but that's just not the way that this one operates. It's just a different approach that's still
absolutely
higher prices and stability, but maybe just a different way of getting there.
Yeah.
Okay, great. Well, thanks for that answer. That was a good question. And it looks like I think we have all of the questions answered that have come through so far and all of the ones that were submitted in advance. So I'll just pause and see if anyone else has a lingering question that we want to address before we wrap up here. Okay, somebody is asking, is the discussion related to this plan far enough along to be included in the next Farm Bill? So maybe less of a question for you to answer, Chuck, and maybe one that I can at least try to take a stab at. So
sure.
I mean, I would say yes, that we do have enough information and enough research to formulate a plan and to get something written legislatively that could be considered for the next Farm Bill. We were very close to getting something adopted in 2014 and just kind of missed the window of opportunity on that. And now we have the benefit of hindsight of seeing what happened after 2014 with the collapse in milk prices and the 5 years that followed and the number of farms that went out of business. So I think looking back at that history and looking at the information that we have, sure, maybe there are other ways to approach this, but it seems like this is a really well thought out plan that a lot of people have put a lot of work into over the last couple of years, and that we have some really clear evidence to show that it would have positive benefits, and also that it's a compromise between some of the different interests and stakeholders in the dairy industry. It's not, nobody's going to do poorly as a result of this program, from what I can tell. So I would say that yes, this is far enough along to be considered for the 2023 Farm Bill. And if we miss this opportunity, if the 2023 Farm Bill comes and goes and we don't make any significant changes to federal dairy programs, I think we know exactly where we're headed, with more farm loss, more price volatility, and it's really just a question of, is that the future that we want, or are we ready to try something different? So that's how I would respond to that. But it looks like there are a couple of other questions. let's see. Oh, someone just says good presentation and discussion. Thank you. Are farmers awarded a farm's existing entry base regardless of size? And if so, can you explain why?
Okay, see if I understand the question correctly, and then I'll, if I need to say something different, because the question is different, I can do that. Basically, the way the program is designed here and how we analyze it would be to say your production base at the start of the program, which in our case would be, if we'd done this in 2014, was to look at the highest herd annual production in the prior 3 years, and that would become your production base for starting the program. And so any allowable growth for your farm would be based off that starting point of the years prior to the start of the program. What was your highest annual milk production? Okay. And so starting in 2014, then the clock is ticking on how much you grow from that and what tier you're in. So I don't know if that answers the question appropriately, but it was designed to sort of think about the fact that there can be some natural variation from year to year and the amount of production on a farm, and to give basically the largest possible base starting out in 2014.
Okay, well, hopefully that answers the question. Please submit another one if we need further clarification on that point. Great, and I think that we have answered all of the questions here. So thank you so much, Chuck. Do you have any final points that you want to make, or any closing comments here?
I guess the final points I make was, again, to remind people that there is a tool that could be used to evaluate the impacts of this on their own farm for any kind of expansion plan that they have in mind. And that we have additional resources available on the dairymarkets.org website, which is what Mark Stevenson and I run out of the University of Wisconsin, that provides additional details about the analysis that we did and additional results. So if people are interested in that, they can go to that website or contact either of the two of us. And I guess, Bobby, you can find a way to make our contact information available to folks.
Okay, great. Thank you.
Happy to do that.
And there was a comment earlier that the dairymarkets.org website might be down, or someone was having trouble with it. So we'll maybe
okay.
Look into it and make sure that, but that website's also linked on the Dairy Together website as well. So that if you go to Dairy Together, you can find the link to the full report and the online calculator tool that's on dairymarkets.org, as long as we're able to get in there. So
okay, thanks for that heads up.
Sure.
That embarrassing heads up.
No, I'm sorry to put you on the spot if people are flocking over there right now. Just a word of warning that it might be having some technical difficulties.
Okie doke.
All right, well, thanks so much, Chuck. Thank you so much for that presentation. I always appreciate hearing your insight on all things dairy. So thank you for taking the time, and thanks to everybody for joining us today, for asking some really good questions. I will share the webinar recording with you, so look out for that in an email, and feel free to pass that along to others that might be interested in learning more about growth management. Also, feel free to reach out to me if you have any lingering questions. It sounds like Chuck has graciously offered his contact info. So if there are questions for Chuck, please reach out. And if you want to learn more about Dairy Together, you can find the full analysis, a link to the online calculator tool, and a couple of videos, articles, and other resources at dairytogether.com. So thanks again, and have a wonderful day.
Okay. Thanks, everyone. You too.